Hey, this is Brian McCarthy coming to you from Cape Cod, which feels and looks like Newfoundland right now. I'm going to talk quickly about Kevin Warsh and the Fed balance sheet. So, Warsh has a theory that if the Fed were to reduce the balance sheet, it would open the room for aggressive rate cuts. This is long headed from a very basic economic perspective. Warsh does not seem to have changed his view on the asset pumping and inflationary consequences of the Fed's expanded balance sheet. As interest rates have gone to zero to above five and then back to 3 and 5/8 again, none of this seems to have mattered to him. That the Fed has dramatically altered the degree to which the money supply is sterilized by movements in the Fed funds rate. This is the primary transmission mechanism of the funds rate to economic activity. So we have an M2 of about $22 trillion. The Fed's balance sheet is seven. I don't know, excess reserves are a few trillion contributing to that M2. It's a little bigger than it would be otherwise. But here's the trick. When the Fed raises the funds rate from 0 to 5, it affects the entire 22 trillion in M2. It sterilizes it. What does that mean? It makes it increasingly inert. So think about a savings deposit you might be holding right now. Maybe it's paying 3.5% if you have a high yield savings account. What would you do if the Fed cut rates to zero tomorrow? You'd be more likely to take that money, buy goods, services, or an asset, right? Economic activity would pick up, the velocity of that money would increase. What if the Fed raised the funds rate to 20% tomorrow? What would you do with that savings deposit? You wouldn't do a damn thing with it. It would become rock solid. And in fact, you'd probably liquidate assets, forego purchases of goods and services to increase your deposit in that account because the rate was so attractive. That would have a deleterious effect on monetary velocity and aggregate nominal spending. So this is how monetary policy works. Warsh's view that the balance sheet is very potent relative to movements in the funds rate is wrong. It will not be well accepted by the FOMC. So he's not going to get a positive response from his new colleagues with this theory. Furthermore, the FOMC is already struggling with reduction in the size of the Fed's balance sheet. That's why they've had to resort to buying bills to increase reserves, because banks have stringent liquidity requirements that force them to hold certain volumes of liquid assets. So until that's changed, there's really no scope for shrinking the balance sheet. I don't think we should be concerned that the Fed's going to return to QT anytime soon. Now, what could Warsh do with the balance sheet? Both he and Scott Bessent have talked about reducing the Fed's footprint in the market. And there's been talk at the FOMC itself of returning over time to an all bills balance sheet. Warsh has repeatedly mentioned the Fed Treasury Accord of 1951, which was an agreement to separate monetary policy from debt management policy. And that sort of went out the window when the Fed started engaging in QE in 2008 and 2009. So both Warsh and Bessent want to return to this. What could that mean for the bond market? Well, nothing, because they could actually just coordinate, do an off-market swap where the Fed hands all its Treasury notes and bonds to the Treasury Department, and the Treasury Department hands the Fed's bills. Voila. The Fed has an all-bills balance sheet. They've removed themselves from being, duration managers in the marketplace, and all we've done is move assets from one bucket of the federal consolidated balance sheet to another. It's really sort of meaningless. So a lot of attention being paid to Warsh and his views on the Fed balance sheet. I don't think much of anything's going to come to it. Thanks for watching. Stay warm out there.